Happy Fed Day, everybody. 25 basis points. Just hit the tape just a few moments ago. The Federal Reserve has increased their Fed funds rate by 25 basis points for the second time in a couple of months. The Federal Reserve has raised interest rates into a bank run. It's amazing. I'm pretty sure this rate hike will go down in history as a colossal policy blunder by the Federal Reserve. We have had the second, third, and fourth largest failures of a bank in United States history, all within the last, 40 days, 50 days? And they just raised rates again. Now, keep in mind, folks, this entire banking crisis that we've been going through and this entire inflation crisis that we've all been living through is 100% manufactured by the Federal Reserve, by their easy monetary policy and then their extremely tight monetary policy to counter. It all, depending when you want to say it started, some say it started in 1913 when they created the Fed, but largely this policy, this series of crisis after crisis after crisis, started with the deluge of quantitative easing and all the money printing that started after the pandemic in 2020. When the Fed printed some $6 or $7 trillion, and they kept printing way, way too long, right up until 2021, November of 2021, when they began their taper, when they began to slowly slow down their money printing. And then the inflation came, and they told us it would be transitory, right? They couldn't even say temporary. They had to mock you by using this overly verbose form of the word temporary by saying, oh, this will be transitory. And we're like, oh, wow, this guy sounds highly intelligent. He doesn't even say temporary. He must know what he's talking about. Well, it wasn't transitory, was it? Something we all learned the hard way last year as the price of living increased by 20% for the average person? And now, since they have raised interest rates at a pace the world has never seen in order to fight their transitory inflation, now the opposite is happening. We're watching banks fail. And they're still raising rates. A bank just failed on Sunday night, folks. We just watched it. They were desperate to get a deal, to cut a deal before the market opened on Monday morning for First Republic Bank. They broke the law. They let JP Morgan get bigger than the law says they're allowed to be, the laws that we passed after the previous global financial crisis. And then Monday, the markets opened, and we've been watching banks fall all week. All week, we've been watching other regional banks. The big banks are getting bigger. The little banks are getting crushed, and they've just raised rates again. By the way, we have got my man, Mish the Mod is here. He is lingering backstage, but he is on audio. Mish, how are we doing today?
Man, I am doing so good. It's a great day out here. I won't be on the thing tomorrow because I'm going to be traveling to California.
We will miss you, Mish, on our next live. But it is good to have you here with this one. Now, Mish, what are you looking for in this press conference? Is there anything that you think Powell might say that would be, say, a signal to markets one way or the other?
I do. I think it's how much he's going to talk about this notion of the pause. Back in September, we got the dot plot, which he has pretty much followed since September. I think this raise would probably be the only thing not on the dot plot because I think he was supposed to be done by now. But, going to 525 is the highest anyone even imagined a year ago. So I think that how much he's going to talk about the pause effect, and then how many times, like Mike said, how many tools is he going to use? Because he's going to have to talk about these tools, because he's lending the money out.
That's right. And, Powell is going to mention that if the bank failures continue, which I have no reason to suspect they're over. I mean, they've been telling us over and over again that the crisis is over. Powell is going to assure us that they have the tools. Thank you very much, Mike, for the super chat and support of the channel. The tools to shore up the banking system, which, of course, when he says the tools to shore up the banking system, that's all word salad for lending more money into existence, i.e. increase inflation. And then if that causes inflation, he'll say he's got the tools to handle that. And, we don't have the tool counter queued up. We used to do that. We used to keep track of every time Jerome Powell mentioned his tools. Mike, you might be onto something here. This might be one we want to count the tools. So
I was going
Everybody
to say,
keep an
we can do it
unofficial
in
count
chat.
for me as we go in the comments. Every time you hear Powell mention his tools, let me know in the comments because that's going to be a big one. And thank you very much, Mike. I appreciate the super chat support of the channel. Miss, you sounded like you were going to chime in a second ago.
Yeah, I was just going to say we can keep it in chat. I think it's also important to notice that the TGA fell by $78 billion last week on the bailout of First Republic. That was that was higher. It's about $38 billion higher than expected. So that's, I think, why Yellen came out and said, "Oh my God, June
Yeah,
1st."
you know, that's another thing. We've got the debt ceiling going on at the same time, and I know a lot of people are saying, yeah, they're going to raise the debt ceiling on May 31st in the middle of the night. You're probably right. That's what they do. But they're running out of money fast. Every time they bail out a bank, and these have been bailouts, even though they'll tell you, hey, this isn't a bailout or the taxpayers won't be on the hook. Yeah, okay, I got a bridge I want to sell you if you believe that. But every time they bail out a bank, they're burning through their cash much, much faster. And that's why the X date, the day that the U.S. government would default on its debt, keeps getting closer. Not only are days ticking off the calendar, but the date is moving up because they're burning through billions of dollars. Every time the FDIC has to take a bank into receivership, the FDIC has to pay those depositors. So they're burning through tens of billions of dollars to do that. Now we are here. It is 2:21. We're 9 minutes away from Mr. Powell coming into the office here. Let's see. Are they giving us their mood music that they usually give us right before Powell comes on? They sure are. All right, we're going to cancel that mood music just for a few minutes here. Now, guys, I also want to add that, you know, there's no easy way out of this. I'm probably not gonna pull any punches when it comes to Jerome Powell over the next few minutes, right? I'm very critical of the man. That does not mean I'm volunteering to do his job by any measure. And I would not want his job because Jerome Powell does not have an out here. He doesn't have an option. He's got a choice between two kinds of crisis. Jerome Powell can continue raising rates to fight the inflation that I would add that Powell and the Fed caused. He can continue to fight that inflation at the risk of making the banking sector worse, right? Because keep in mind, our banks are failing right now. All these different reasons. Silicon Valley Bank had a unique customer base, and First Republic had some unique mortgages, and Signature had the crypto thing and some commercial real estate. But push comes to shove, when you raise interest rates, debt instruments fall in value. All right, the price and the interest rate are inversely correlated. So our economy runs on debt. And every time somebody borrows money, that debt gets bought and sold back and forth all around the world 5 times an hour, seemingly. And when the Fed raises interest rates, they lower the value of that debt. And we're sitting on a mountain of debt, right? The national debt is $31.5 trillion, but there are hundreds of trillions, quadrillions of dollars of debt instruments circulating in the world. And all of these debt instruments are owned by banks. You see, when you give money to the bank, you've made a loan to the bank. So your money in the bank is a debt instrument. It is debt for the bank. In order to make up for that, the bank has to take your money and they go and they buy some asset in order to make more interest than they're paying you. That could take the form of a U.S. Treasury bond or mortgage-backed security, or the bank could go out and give loans. But either way, those debt instruments that the bank invests in with your money function exactly the same way as a bond does. When the Fed hikes the rates, the value of those investments fall. So the Fed, all through 22, was hiking rates at a pace the world has never seen. They were lowering the value of all of the investments that the banks bought using your money. But remember, the banks bought a ton of those investments because heading into this crisis, deposits in U.S. banks were at all-time highs because the Fed had just dropped trillions of dollars of helicopter money into the economy. People got that money and they either spent it or they put it in the bank. So the banks got this huge influx of deposits, and they had to go out and they had to buy trillions of dollars worth of assets with all that printed money. And then the Fed raised the interest rates, and the value of those assets that all the banks bought started to plummet. Well, the banks still owe you that money that you deposited in there. And that's why the banks are failing. Their liabilities, the money they owe you, is more than their assets, the investments that they bought with your money. And when they run out of money, the bank fails. Now, the big banks are more insulated from that, but they're not immune to it. The big banks have the same problem, but the little banks will fail first. Everybody knows this. And so we've been watching the little banks fail, even though these are the second, third, and fourth largest bank failures in history. These are little banks compared to the behemoth that is JP Morgan or a Bank of America or a Wells Fargo. So as the little banks fail, the big banks are coming into the rescue. Jamie Dimon thinks he's freaking Superman. They're coming in and they're buying up the assets from these failed banks at pennies on the dollar. So the big banks are getting bigger. The taxpayers are eating the cost of this because the FDIC is having to bail them out. And when enough banks have failed, Jerome Powell and his gaggle of PhDs over at the Federal Reserve is going to decide to lower interest rates in order to shore up the financial system. Well, lowering interest rates works just the way hiking interest rates does, except in reverse. So when they lower interest rates inevitably, and the market thinks this could start as soon as September, I think it'll start sooner. When they lower interest rates, the value of all these assets that the big banks have gobbled up through these failures is going to go right back up. So the big banks are going to make tens of billions of dollars off of the mayhem going on in financial circles right now. I mean, this is wholesale theft. This is a takeover of the banking system by the big banks and the Federal Reserve that we're watching play out in real time right now. And thank you very much, Dan Hedin, for the super chat, sir. That's covering up half of my melon of a head right now. He says, Jack, for head if the Fed for one day. I'm not sure what you're saying there, Dan Hedin. He says, first and only task to dissolve the... if Jack... He's saying right. Jack for head of the Fed one day. He's nominating me to run the Federal Reserve. That's right. My first and only task will be to dissolve the Fed. And I can't take credit for that one, Dan Hedin. That was Joe Brown over at Heresy Financial who said that one first. And I would happily serve as Joe Brown's vice chairman and assist him with the dissolution of the Fed. Man, I do not want to think about JP's tool. No, let's not talk about Jerome Powell's tool, please, especially after yesterday and the Janet Yellen thing about hoovering up dollars from the economy. Nope, we're good. We're all good on that. Thanks. We're all tooled out here, Dan Hedin. But thank you very much, sir, for the super chat and the support of the channel. I appreciate that very much. All right, guys, we are 3 minutes out from Powell coming out here. Some of the things we want to hear about. We'd like to hear about quantitative tightening. We would like to hear him say, are they going to continue quantitative tightening while they pause on interest rates? Most people think they're done hiking from here. The other thing I'd like to hear about is commercial real estate. I have not heard Jerome Powell mention anything about commercial real estate. That is a $1.5 trillion ticking time bomb sitting in our financial system, mostly on the balance sheets of small banks, which are struggling right now. And we haven't heard him talk about that. I'd also like to hear him talk about the job market. Is he still going to insist that the job market is so strong? We got that ADP payrolls report this morning. That was pretty good. And, well, that's about it. And, of course, he's going to assure us that he is acutely aware of the pain inflation has caused us. He's going to make it seem like he's just a regular guy. Let's not kid ourselves, folks. Jerome Powell is not just a regular guy. He has no idea what the average person has lived through the last 15, 16 months or so of very high inflation. Also, I want to let you guys know, you might see above my chart here while Powell is talking, I've got a couple of different charts set up here. I've got the S&P 500. I have got gold prices. We'll see if gold moves in reaction to anything that Powell says. I've got the Dow Jones Industrial Average currently up 63 points. I've got something a little bit new today. We're going to watch a couple of these regional banks. Right now, I've got PacWest. That's one of the banks. That one was down big yesterday, about 25%. So we'll see if these small regional banks react to anything that Jerome Powell says today. We've also got the NASDAQ, which is looking like it's loving life right now, up 100 basis points. And then we've got silver is up here. Silver's doing pretty good today. The DXY, the value of the U.S. dollar. We've also got Western Alliance Bank, which is another one of those small regional banks that's been on the fence lately. We've got the U.S. 10-year Treasury. We're going to see if that moves when Powell talks. And we've got Metropolitan Bank, another one of those small regional banks that's been behaving a little bit wonky these last few days. So I'll be cycling through these charts as Powell is talking every few minutes, and I'll point over my head if I see anything that catches my attention. And right now we are just a few seconds away. Here we go. It looks like Powell will be coming into the room any minute. I'll be going on mute when Powell starts talking, and I will chime in and speak over him if he says something that grinds my gears and I just feel the need to vent. You'll forgive me if I do that. Are they still giving us the mood music right now? Or I feel like I'm in the room with all of these journalists, and I use the term loosely, by the way, while we're waiting for Powell. These are scripted, pre-screened, pre-approved questions that are going to be asked after Powell's scripted, pre-screened, pre-approved remarks. So understand that this is financial theater right now that we're all about to watch. And just once, I'd love one of these journalists to go off script and ask a legitimately probing, feet to the fire kind of question of Jerome Powell, like just how many millions of people are you willing to put out of work in order to accomplish your 2% inflation target that you set after causing inflation? And here is Jerome Powell. And thank you, Jose Orozco, for the super chat.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
I told you he'd say that. Every month he has to say that.
At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor.
This happens, folks. We're getting a little bit of lag. We'll work through it here right now. But he just mentioned the
Labor market
cumulative.
conditions.
Oh, here we go.
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Now comes the scripted questions.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting.
So it was a pause, not a pause. You got all that? Pause, not pause?
So the staff's forecast is, so let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel. Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Chairman, oh, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of
That's
banks.
a cheap answer. That's
it wasn't,
a cop-out. He was warned and he did
wasn't
nothing.
presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful, but ultimately it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned, I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank and there are many other banks that are experiencing these things, and we're on the case.
We're on the case. That was his answer for that. Wow.
Hi, Chair Powell.
Oh, wow.
I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
The FDIC was also bound by law not to allow that merger.
In general.
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
We have to follow the law. They just broke it. They just broke it a few days ago.
Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted, but that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now, but nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to. Before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
A follow-up on credit, if I could you give us a sense of what the SLUICE survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUICE on May 8th, in line with our usual time frame. And I would just say that the SLUICE is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Go to Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation for it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would be okay with a prolonged 3%?
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Yeah, he's saying wage gains are higher than if inflation was 2%, but inflation isn't 2%.
Chair Powell, Matthew Bosa
5%.
with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really.
Did the Fed chair
labor
really
market.
just tell us this time is different?
It's interesting, is, we've raised rates
Wow.
by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That
Banks
would
are
be against
failing,
the
Jay.
pattern.
No.
But I do think
No,
that
the soft landing is
that
not
this-
happening.
That the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible.
There's
that
no
we will
way
have
he
I
believes
hope
what
would
he
be
just said.
a mild
No way.
recession.
Never play
Also
poker
noted
with
in
this
March
man.
that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver, because I don't think that's really right.
Yeah, let me help you out. It's your money printer in the basement that's driving inflation, Jay.
Associated Press. Well, you
Give
mentioned
you that one
profit
for free.
margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, you know, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And you know, so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but you know, we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and you know, markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to. Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
He left the door open, though, didn't he, to a rate cut just there? He said if they're right, they won't need
Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's, I don't really think we should be, we shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say no one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. What our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
He just said Silicon Valley Bank failed suddenly and unexpectedly when 3 weeks before it failed, he sat in on a presentation that described Silicon Valley Bank failing for that very reason.
Are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the beige book, and you will see in the SLOOS is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for Supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for Supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close, or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then, that we're going to revisit. It's pretty clear we need, to me anyway, it's clear that we need to strengthen both supervision and regulations for banks of this size. And I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
All right. Well, wasn't that fun? Give me 1 second here. We're gonna reset a couple of my things going on here. Let's get me a little bigger. We're gonna leave the Fed's backdrop up there, and we're gonna bring in my man Mish, and we're gonna talk. And the first thing I got to talk about, I got a super chat while we were going here, and let's bring Mish in to say hi. While we were talking, Nashville Pasta Man left this super chat, and this is right on the money. They were asking about J.P. Morgan, and asked about why J.P. Morgan was allowed to get so big. And Nashville Pasta Man, you're right on the money here. He says Dodd-Frank says that no banks are allowed to be over 10% of deposits. The wording is subtly different than that. No bank is allowed to merge with another bank if the resulting bank will be more than 10%. All right. And when JP Morgan bought First Republic Bank, the resulting bank was more than 10%. So that was explicitly against the law, that merger. And you are right on the money here in Nashville. So they've defined GSIBs. FRB was by definition much smaller than that threshold, fourth GSIB exception. All right, so GSIB stands for global systemically important bank. Again, very subtle wording differences, Nashville. You're right there. You're right in the ballpark. They didn't necessarily declare First Republic Bank a GSIB. They did, however, say it represented a systemic risk to the economy. That was the thing. They gave it the systemic risk exemption. They didn't say it was a GSIB, but the language is very similar. Word salad, man. I mean, they're like right there. So they did basically say it was a systemic risk, and therefore we can't allow First Republic Bank to fail. And that's why they didn't bail in the company's shareholders. That's why they didn't bail in the uninsured depositors. That's why they guaranteed everything with the FDIC funds. All right, so will anyone challenge the categorization of First Republic Bank as systemically important? And I think we've got the answer, Nashville. The answer is no. Nobody did. And very few people even pointed out that it was illegal. I mean, a couple of people did. I'm shifting in my chair here because I've been grinding my molars since he started talking. But, you're right, Nashville. Nobody's even saying, hey, this was not legal. And they just did it at 2 o'clock in the morning while everybody's sleeping. And by the time they told us they were doing it, it was already done and the regulators had already approved it. No, nothing of that. And like the lessons learned or the takeaways. I mean, they just did it. Watch me. They did it. So thank you, Nashville Pasta Man, for the super chat. I wanted to mention this one specifically because this came up while he was talking and it was lingering there for a while, but you're right on the money. I mean, when they asked him about that, when they asked him specifically about bank consolidation, JP Morgan becoming an even bigger behemoth, the whole point of Dodd-Frank was no bank should ever be allowed to become too big to fail. Right? Too big to fail means too big to exist. And we have just absolutely destroyed the intent of that law. The whole spirit of the law has been completely obliterated with this JP Morgan First Republic deal. And the Fed sat there, watched it happen. The Treasury watched it happen. The FDIC gave it their blessing. It's done. So, too big to fail is no longer a thing, folks. It's not. Or everybody's too big to fail now. Everybody. The idea that we're going to prevent too big to fail, it's gone. They threw it right out the window. Thank you very much, Nashville Pasta Man. I very much appreciate that super chat. And we got Mish in here. I got Mish for about 5 more minutes. I know you got a 3:30 hard out mission. We're going to honor that one. So give me your take, bud. What do you think here?
I think what I heard is that he was pushing that idea that he took a statement out and he had another statement statement. I think the pause is in effect now, and he was trying to kind of dance around that a little. That is the going forth baseline now. So I think, someone had asked, and I just remembered what the question was, is what's the difference between when they pivot and when they pause? And for me, pause is just kind of status quo. They're going to pivot when all hell breaks loose.
Yes.
So once the hell has broken, then they'll pivot.
Yeah, the pause is when they stop hiking, right? Pause, stop. And then the pivot is when they change direction. That's when they start cutting. And they touched on that one a little bit. Where I got a lot of notes here, and they get sloppier as they go because I get angrier. So forgive me for trying to he left the door open. Where is it? Oh man, I can't even read. Okay, he was asked about a rate cut by the end of the year. And the first thing he started talking about was they have noticed credit conditions tightening. All right. Now, the purpose of a rate cut is to loosen lending conditions. So when he was asked about the pause, and the first thing he says is he sees credit conditions tightening, he's suggestive of a rate cut there. But then he said, if we're right, we won't need to cut. Which, is this a bad time to point out they've been wrong about literally everything since 2020? Nuance.
Well, I think that's the narrative of the soft landing again coming out. That we're gonna do this kind of machination to where we hit it just right, and okay, great. If you do it, you do it. If you don't, we're all screwed. And I think in the beginning, people didn't realize raising rates causes unemployment. So this has been going on for 14 months, right? And he's saying it really hasn't moved much. It really hasn't, based on what he thinks it should be happening. So they're going to keep screwing down that screw until it breaks. And then we have it. Now, someone keeps asking about why isn't gold crashing right now? For a strong current economy, the problem is we still see a flight to safety going on. And that is overwhelming any other mechanism right now.
Now, I don't think we see, why aren't we seeing gold crashing? We don't really see anything really moving off of what Powell said today because he walked the line today. He was non-committal. He danced back and forth. So I didn't really see any market signals beyond what the market was already expecting today. So
He was in 100% neutral, and he wasn't even coasting down a hill. He was just on flat and neutral.
Yeah. Yeah. I mean, and now the whole thing, I got to say this again. I know we're running short on time. This time is different. To hear the chairman of the Federal Reserve mutter a cliche that has preceded every financial calamity or every boneheaded financial move in history is telling. That one may not age so well. I think they may be playing that one in the documentaries about what went wrong in 2023 and who could have seen this coming. I'm pretty sure they're going to play that clip of Jerome Powell saying this time is different when he was saying, yeah, I think we can avoid a recession. Jay, the second, third, and fourth largest bank failures in U.S. history have happened in the last 6 weeks, and you're still saying you think we can avoid a recession. You still think we can have a soft landing. Jay, banks are failing all over the country. You've already, hey, the captain of the Hindenburg says it's not too late to pull this one off. I'm just saying, maybe the Titanic may still arrive on time. Oh, my God. Hey, look, Mish, I know you got to drop off. Drop off whenever you have to, brother. That's fine. Thank you very much for everything you did. Everybody say, well, we're not going to say goodbye to him. I'm not kicking you off. I know you got somewhere to be.
I was going to go ahead and say goodbye here. It's almost 2:30. I will see everybody probably on Friday morning while I'm traveling. So cheers, everybody. We'll talk to you
Safe
later.
travels, Mish, and enjoy the road, sir. All right. Mish is dropping off for us now. Thank you, Mish, for being with us. Got a few more thank yous I got to send. Thank you very much to Norman, who sends, I believe that was a super sticker. Just being a swell guy. Thank you very much, Norman. I appreciate the super chat very much and the support of the channel. And there was a few other ones I saw in there. Who do we have here? Jake's Custom Parts. Thank you, sir. It says awesome channel, Jack. Thank you. Well, thank you, Jake. Awesome super chat on my awesome channel. I appreciate that very much. Hey, by the way, to the 1,035 people who are watching right now, please remember to like and subscribe while you're here if you're new. We do this every time Powell goes live. We also go live every morning. And, we go live on Friday afternoon. We do regular videos. Thank you very much, Jake. I really appreciate that. And thank you to Chris, who says the Fed will continue to destroy banks until they have to consume them all and issue the CBDC. Yes, Chris, yes. Is this the reset taking place? I think whether that's Jerome Powell's explicit goal or not, I can see that's where this is going, all right? First you create the crisis, and then you offer up the solution to the crisis that has been your goal all along. And I do see this happening. I mean, look, he just hiked rates again. We've had 4 bank failures, 5 if you count Credit Suisse. Silly Bank, the 3 silly banks, right? Silvergate, gone. Silicon Valley Bank, gone. Signature Bank, gone. First Republic is gone. And Credit Suisse are gone, right? We've had 5 bank failures, and he hiked 2 more times. So to say they're doing it on purpose, right? I mean, and he was even asked about why did you do this hike? You know, how did you arrive at that decision? Because they're on autopilot. They're not data dependent. They just do. They don't know why they're due. They're told and they do. And I really do think the CBDC is coming here, and I don't think that spells very good things. I think if the CBDC is allowed to take hold, especially in the West, I think that will usher in an entire era of totalitarianism, and it will not be an easy mistake for society to walk back. So resist it with everything you got, Chris, as I do. Always remember, you can always unbank yourself with the ownership of physical precious metals like gold and silver or Bitcoin. That is how I insulate against the CBDC, and I've had a lot of people criticize that. I said, look, that's just like a compensating measure. That doesn't like say, can't touch me, CBDC, I've got gold. No, that's not how that works. Your life can still be made miserable. It's just your life will be much less miserable than the person who didn't take those precautions, right? When you buy gold, silver, you're not improving, you're not getting rich. You're just improving your worst case scenario. I once heard Doomberg, the fantastic money chicken of the internet over on Substack, he described the ownership of precious metals as raising your floor. It doesn't really do anything to like, you're not going to prosper, but at least your worst case scenario gets better. And that's a pretty good description. Thank you, Chris. I really appreciate the super chat and the support of the channel. Did I get everybody? I did. All right. A couple more notes. Let's go over here. We got a few more things that he said. He went right after the bank failures as soon as he started. And he started talking about the lessons learned. So there was like a little bit of a mea culpa there. But at the same time, when they were asked about the lessons learned of the bank failure, and we'll talk about 2 things here. He said that nobody could have seen Silicon Valley Bank coming, right? The lessons from the crisis was the speed with which Silicon Valley Bank happened. All right, so 2 things here. When there's when there's references to the speed of Silicon Valley Bank, that's a little worrisome for me. I've heard a lot of people talk about the speed of Silicon Valley Bank's failure. And that implies the solution is to slow things down. And understand what that means. If the solution is to slow things down, that means they want to put mandatory waiting periods on your access to your money. Right? A lot of people are blaming digital banking that, I can just log in and empty my bank account at any time. It used to be much harder than that. So the solution is to just lock all the poor people below decks on the Titanic. That's why I worry about Jerome Powell making references to the speed of Silicon Bank failing. All right, so that's one thing. The other thing is when they said, nobody could have seen that coming. And there was another question that was referring to a February 14th. Was it February 14th? Yeah, February 14th presentation about unrealized losses in banks. All right, Jerome Powell quite literally sat in on a PowerPoint presentation about unrealized losses and the risks to banks caused by rapidly rising interest rates. And within that presentation, there was a slide that specifically called out Silicon Valley Bank. Sorry about my throat, guys. It specifically called out Silicon Valley Bank for their exposure to long-duration U.S. Treasury bonds. So Jerome Powell said nobody could have seen Silicon Valley Bank coming except for me and the whole room full of people who watched the presentation specifically detailing how Silicon Valley Bank could fail for exactly the reason why Silicon Valley Bank failed. All right. So this was, I mentioned I'm not going to pull any punches on Jay Powell earlier in the stream. This was some of the most dishonest, outright lying behavior I've seen from Jerome Powell yet. All right. For him to say nobody could have seen this coming. Bro, you sat through a presentation that described this exact phenomenon just 4 weeks before it failed, or 3 weeks before it failed. Come on, Jay. Come on. Do not, lie to us. That's fine, but don't insult our intelligence while you lie to us. So that was when, and I saw, I think it was M&J left a comment like, "Oh boy, Jack's face is getting red." You could see it on me. I was shifting in my chair a lot. That was blatant dishonesty there. Just blatantly dishonest. He mentioned a couple times about wages going up, and he said wages are rising about the cause of inflation. He said wages are rising faster than would be consistent with 2% inflation. Okay, that's fine, Jay. Wages are rising faster than they would rise if inflation was 2%. But that's because inflation is a lot higher than 2%, Jay. Inflation is 5%. If you go by CPI, it's actually probably closer to 12 to 13% if you go by what life is actually like for most people. So wages going up 5 or 6% is not a problem. That's wages not even keeping up with inflation. And real wage gains in the United States have been negative for 24 months in a row. That is 2 years straight of the quality of life of the average American getting harder, getting worse. And he's sitting here talking about wage gains like they're too high. They're not high enough. All right. If inflation is a problem, don't print money. All right. If you don't like inflation, stop printing money, Jay. Stop lowering rates every time your buddies start losing money. And then complaining when the little guy wants to catch up. Because the little guy is taking it on the chin from you and your buddies for the last couple of years or the last few decades. Stop printing money. Just stop. All right, I got another super chat here. Where was it? Thank you guys for the super chats. I appreciate it. Oh, Chris is back. Thank you, Chris. Says, I think the CBDC could be good if they pass legislation to make non-programmable. They won't. This would improve our financial system. Thoughts? No, I don't. Sorry, Chris. First of all, thank you for the support of the channel and for the super chat. But I have to disagree with you here. All right, and it's all right. This isn't an echo chamber. You're not required to agree with me. I don't see any reason for a central bank digital currency. And I'll tell you why. That first letter, central. That's the problem with the CBDC. It gives control of it to the government. Even if they make it non-programmable, it's still money that the guy who just lied to us about Silicon Valley Bank being unexpected and the guy who told us the problem was we're allowed to get to our money too quick, it still gives him total control of it. And that's not good enough for me. It shouldn't be good enough for anybody. So the C in CBDC, before we even get to the second letter, you've already lost me. And that's why I think no matter how they try to sell it, spin it, program it, not program it, I think it's a non-starter for me and it should be for anybody else. As far as improvements to the financial system, Bitcoin does the same thing. PayPal does the same thing. Venmo does the same thing. And Neil Kashkari, who I criticize very often, I don't often praise him, Neil Kashkari said the same thing. There's nothing you can do with the CBDC that you can't already do with freaking PayPal. So what's the point other than for the government to seize control? So no, sorry, Chris. You lost me at C. That's it. We didn't even get off the first letter and you lost me. But thank you, sir. I do appreciate the super chat and the support of the channel. And thank you, Van E. Or is that Vane? Thank you, Van E. He says, are bank examiners still a thing? Where's the IRS? The IRS is out there busy hiring up 87,000 new agents to surely not come after you and I, right? By the way, one of these days, I'm going to have to make the video about getting audited. I know I'm going to get audited. I'm going to get myself audited with this channel one day. It's bound to happen. It's bound to happen. Are bank examiners still a thing? They released a report about the failure of Silicon Valley Bank. Nobody has asked for Mary Daly's resignation. Mary Daly is the head of the San Francisco Federal Reserve Bank. And on Mary Daly's watch, now Silicon Valley Bank in her area failed, and First Republic Bank, which is also headquartered in her district, failed. And I would also add that Mary Daly personally signed off on the letter welcoming Moonstone Bank to the Federal Reserve System. If you don't remember Moonstone Bank, that's Sam Bankman-Fried's shed that he turned into a bank that he bought, and he was welcomed into the Federal Reserve. Here it is. I keep a picture right here. That is Moonstone Bank, formerly Farmington State Bank in Farmington, Washington, or Farmington, I think it was Washington. That is the bank that Mary Daly welcomed into the Federal Reserve System that was owned by Sam Bankman-Fried and the folks at Deltec. That happened on her watch. There's Mary Daly. Nobody has asked for her resignation yet. But there was plenty of training going on at the San Francisco Fed about a kinder, gentler workplace, all that ESG stuff, and all the DEI mandates were all met, all right? Forget that the banks in her district are failing and that a shed can join the Federal Reserve System in her district. So, are bank examiners still a thing? I don't think so, Vane or Vanny. I don't think so. If they are, you could have fooled me. All right, let me make sure I didn't skip anybody here. Oh, I did skip somebody here. Thanks again, Mr. V. I appreciate that. And thank you, Paw the Beagle. Says CBDC, look no further than Lael Brainerd, who is, well, no, Lael Brainerd is no longer at the Fed. She's now the head of one of the White House Economic Advisory Councils or something like that. But yeah, that's a perfect example. Lael Brainerd, and my God, if she were ever put in charge, what would happen to a CBDC? And everybody, well, we'd all be millionaires. That's the good news. We'd all be millionaires. The bad news is $1 million would buy you a loaf of bread if Lael Brainerd was put in charge. So I agree with you there, Paw. Mr. Paw the Beagle. Again, I am just adamantly, fundamentally, at the core of my being opposed to a central bank digital currency. It strikes at the very core of everything that is Melonhead. And thank you, Dakota Prairie. He says, your channel is awesome. Keep up the great commentary. I'm trying, brother. I'm trying, and I love doing this. I will do this as long as they let me, until they unplug me or audit me into oblivion or who knows what else. I shall remain on the tubes as long as they let me. Thank you for the super chat, the generosity, and the support of the channel. And I think, no, I'm not all caught up. I thought I was. Cold Steel. There's a good name. What's going on, Cold Steel? Says, Jack, thank you for everything you do. I rarely catch you live, but I appreciate your detailed analysis on the markets and the Fed. Well, thank you, Cold Steel. I appreciate the kind words. Appreciate the super chat, the support of the channel. You've got an awesome handle, Cold Steel. Tell me the riddle of steel, Conan. And thank you, Cruisin. Cruisin just sends a super chat. Let's see, what's Cruisin? It's super stickers don't come up. Nope, nothing to say, just being a swell guy. Well, thank you very much, Cruisin. I really appreciate that. Thank you guys all. I appreciate your generosity. All right, look, we've been going for almost 90 minutes here. This is long even by my standards. I usually don't run this long, but I had a lot to get off my chest after Powell was talking. So I want to say thank you very much for all the super chats, and welcome to all you new folks. Please remember to like and subscribe while you're here. We do this every time Powell talks. We also do a lot of live streams during the week. We do regular videos also. And also tonight at 7 p.m., hey, my Patreon folks, are you out there? We will be gathered at 7 o'clock on Zoom for our weekly Patreon Zoom call. I'm sure we're going to have plenty to talk about with Powell's speech right now. There's a link down below in the description should you feel so inclined. And I would be remiss if I did not say, hi, Mom, hi, Dad. I love you guys. And until next time, everybody, live small and dream big.